Well, thank you, everybody. Welcome to the 6th edition of the Washington Area International Finance Symposium. We are very glad to host the event this year. We are glad that we could be in this room. This is not for you that all of you that have not been here. This is not the boardroom, but it's the backup to the boardroom that is on the other side. And if they need this room, they can kick us out at any time. I hope it doesn't happen. But let's enjoy it. This is a nice room. We have a huge success with this conference. We had a record number of close to 300 registrations. There are a number of people that are attending online. We have advertised the conference to institutions, universities in developing countries, so they are watching online. And we will post the video later on, as well as the presentations. We also have a record number of participants in the program, so we have a long day ahead. So let me just say a couple of things, one on logistics and the other one on thank yous. And then I pass the floor to Sebnem and Anusha. On logistics, if we reach the capacity on this room, there is an overflow area where you can sit and watch the conference, but as seats open up, please come here. We are, as I said, streaming the conference on the conference website. That's the stream. The coffee breaks and the lunch will be here outside. But if you like something different from what we can offer here, there is a great cafeteria in C1. So if you go through the elevator to the C1 level, there is a nice cafeteria, a nice coffee shop with a lot of different options. And the restrooms are on this left side if you need them. So in terms of I have to thank all of you for coming and your enthusiasm. Also Thomas William, who took the lead in organizing the program. All the support staff from the research group, Andrea, Claudia, Michelle, Ryan, others that made this possible. And also to Sebnem and Anusha for opening the event. So let me pass the floor to Sebnem and Anusha. Thank you.
Thank you very much. It's a pleasure to be here. This initiative is dear to my heart. When I first moved to DC, it was appalling to me that there is no such thing in DC with the concentration of international economics in this town. And when Tim, Nathan, and we started this whole rotating across institutions, we never imagined it's going to grow that big. And now Sergio and World Bank took it another level. So super, super happy to be here. And I'm also, again, super, super happy and excited to introduce Anusha to all of you. You, of course, know her. So she's very well known to economists, not to all of us in international finance and macro, but to the profession at large. So I'm not going to go through details, but let me highlight a few things from her extremely long CV and successful career. Anusha is a professor of economics and finance at the University of North Carolina, Chapel Hill, and she's currently on leave because she's serving on the U.S. President's Council of Economic Advisors. She's also affiliated with NBER and CEPR and holds a PhD in international finance from UCLA, served at several prestigious faculty positions. She was also the inaugural director of the Modern Indian Studies Initiative at the University of North Carolina at Chapel Hill, and a special advisor to Indian Prime Minister's Economic Advisory Council, and a member of advisory group of eminent persons on G20 issues. On top of all this, she worked as the chair of CSWEP from 2022 to 2024. This is a cause dear to my heart. I was associate chair before her. I actually wish I work at the same time with her because she took the whole initiative of CSWEP to definitely another level. CSWEP is the Committee on the Studies of Women in Economic Profession. And she did this during the pandemic time when, all of us was locked down with several new initiatives, mentoring, helping young junior women to navigate this field during such difficult times. So She's an asset to have to the profession on all dimensions, not just in terms of research, but giving back, to the profession and to the public. Ladies and gentlemen, Anusha.
Thanks so much, Sebnem, for that very kind and gracious introduction. And I want to thank the organizers for inviting me to present here today. And as it turns out, what I'm going to be talking about is private finance for public infrastructure in emerging markets, which I know is sort of a top priority at the multilateral development banks, the World Bank being at the forefront of this. So what I'm going to really talk about is how do we get private sector participation in the provision of public capital, and what are the considerations that arise over there. So before I begin, I want to acknowledge my co-authors and co-participants on this project. So it's Peter Blair Henry, who also needs no introduction to this audience, a longtime friend and co-author. We have Yanru Lee, who is a postdoc at the Hoover Institution, and Yanru is here. He's sitting in the back. Can tell you more about this initiative, and Pablo Picardo, who's a graduate student at the University of North Carolina. So this is really a research program that I wanted to share some details with you today, and two facts motivate this research program. The first is the observation that although we have lifted millions of people out of poverty around the world, if we look at poor countries, we see that 1.2 billion people, so that's about 15% of the planet, still has no electricity. Moreover, 1 billion people live greater than 2 kilometers from an all-season road, and 2.6 billion people do not have internet access. And so how do we get the infrastructure investment that we need to bring electricity, roads, internet, etc., to around the world? The World Bank claims that by moving billions to trillions of infrastructure investment in poor countries, which is essentially incentivizing private capital in developed countries to finance infrastructure in developing countries, what rich country private capital can do is to close the infrastructure services financing gap. Secondly, this would allow us to achieve the sustainable development goals. And finally, this has to be profitable. So this is a way in which rich country capital can actually make money. And what we're going to do, today is really talk about, is the World Bank's claim true? Are there publicly efficient and privately profitable infrastructure investments in developing countries, and how would we identify them, and what are the ingredients that we need to do this? And I want us to think about this global infrastructure financing gap in the context of the public debt explosion in developing countries due to climate transition, pandemic-era deficits, wars, etc. And further, there are a number of countries that are in this vicious cycle of building up debt, having a debt crisis, not being able to repay the debt, having some sort of relief program, and then we reset and repeat. And recent examples include Ghana, Zambia, and Sri Lanka, who face this predicament. So related to that, how can emerging market governments invest in public infrastructure with these fiscal constraints and lack of fiscal space? And the World Bank's claim is that public-private partnerships in infrastructure may offer a way. I thought I'd put up this chart so you can see that the billions to trillions dream has not yet been realized, in the sense that over the last 2 decades, private participation in public capital in infrastructure, which is the blue line, has pretty much stagnated. And if you want to sort of compare this, you can see that this is not the same for FDI investments in general, right? So capital is moving across borders in the form of foreign direct investment, but just not in terms of infrastructure investment. So what is clear is that emerging markets and developing economies need more infrastructure investment, especially when we think about the expenditures for climate mitigation and adaptation and the climate transition, including the energy transition. And what is also clear is that given these fiscal constraints, the private sector must play a large role in this process, with the MDBs leading the process of informed risk-taking. So I'll get into what I mean by informed risk-taking in the sense that what the World Bank and other development banks have at their what is possible is that they are able to signal good projects and good governance, which could then catalyze this private investment at scale that could really make a material difference in emerging and developing economies. So I just want to also highlight that the reason that we are also really focused on, the importance of foreign profitability or realizing rates of return is that much of the past public investment in EMD infrastructure has been unproductive. So there are a couple of studies. One shows that more than 33% of public investment in EMD is lost due to inefficiency. And there's also evidence that the Chinese Belt and Road Initiative loans have had realized a mere return of 1.7%. So the question this really brings us to our main question, which is, are there in fact EMDEs with infrastructure projects that are both publicly efficient and privately profitable? And to answer this question and drive better outcomes, we really do need a different and a new approach. And so this brings us to, I just want to provide a conceptual framework so that we can engage in a thought experiment to see what it would mean to have publicly efficient and privately profitable infrastructure investment. And to do so, I'm going to talk about the dual hurdle framework of Gardner and Henry that allows us to sort each country infrastructure observation into one of 4 quadrants. And then what we're going to see is, are these projects clearing 2 hurdles? One is domestic efficiency. The second is foreign profitability. And so to test the World Bank's claim and answer this question, we take the perspective of a benevolent global social planner and apply this dual hurdle framework. And I want us to do the following thought experiment. In a given poor country, is it efficient to allocate a marginal dollar of savings to infrastructure? So let's fix a country in mind. Think Bolivia, Zambia. Think of a road infrastructure project and ask this question: is it efficient for the country to allocate a dollar of savings to build that road? And that brings us to the domestic efficiency hurdle. And so a few definitions are helpful. So if you look at the bottom there, the 3 variables that I want to define are Rx, which is the rate of return on public infrastructure. The second is RK, which is the rate of return on domestic capital, private capital. And the third is RK star, which is the rate of return on foreign capital. And what we're going to do is that we're going to plot the first hurdle, or the domestic efficiency condition, on the x-axis, and the foreign profitability condition on the y-axis. And think about what it would mean to clear the domestic efficiency hurdle. And it's very simple. We just look at rho xk, which is the ratio of the rate of return on infrastructure to the rate of return on private capital, right? And if this ratio exceeds 1, we know that the return on public infrastructure is greater than the return on private capital, and the project would clear the domestic hurdle rate. So if you look on the first quadrant, and you look to the right of the number 1, that is the region where we are clearing the domestic efficiency hurdle. Now, the second thing is, okay, well, if we want foreign capital and foreign private capital to move to invest in and participate in these developing country infrastructure projects, what is the most efficient way to allocate a marginal dollar of savings in a rich or developed country? And so here, what I want to point out before I go through this foreign profitability hurdle is that the reason that we're going to focus on the return on foreign private capital and not foreign public capital is that the data suggests that the return on foreign private capital exceeds the return on foreign public capital. So R K star exceeds R X star. So we're going to look at the binding constraint is really the R K star, or the return on foreign private capital. So here, if we look at the y-axis, we have the analog for foreign profitability, which is, does the rate of return on public infrastructure in developing countries, does that exceed the return on private capital in rich countries? That returns gap is what could potentially drive the flow of capital from rich countries to developing countries. And so if we again look above 1 on the y-axis, that green shaded area is quadrant 1, where we clear both hurdles and we have domestically efficient and profitable investments. Now, the other quadrants, if we look at them, in quadrant 3, we cleared the domestic efficiency hurdle but failed the foreign profitability one. In quadrant 4, we failed the domestic efficiency hurdle, but we cleared the foreign profitability hurdle. And quadrant 3, we failed both hurdles, right? So what are we trying to do? Is if we want to catalyze this private investment, we really want to populate quadrant 1. We want to identify and populate quadrant 1. And so this provides a very useful conceptual framework to organize our thinking. But while there is conceptual clarity, we have a data problem. In other words, we have a recipe, but we don't have the ingredients. And that's where our research program comes into play, which is that we have antiquated data on infrastructure returns, and these are the binding constraint on implementing this rational approach to international resource allocation. So this might really surprise you that the only systematic estimates of returns on infrastructure across EMDBs are from 1985. So the costs of, like if you want to build a road and you wanted to see how much is this going to cost me, the estimates that we have are based on prices that are 40 years old. So what this essentially means is that this lack of information on economic rates of return, which is using these prices from 1985 and stocks of roads from the year 2000. So that's 25 years ago is when we took stock of the roads capital infrastructure. This lack of information on economic rates of return implies that both governments and investors are flying blind, right? Because there's no way to to sort of actually compute at the moment. There's no way to compute what are these economic rates of return if I want to go and build a road in Bolivia, for example. And so this is sort of what is standing in the way of this prioritization of capital allocation. And some governments claim that the suppliers of capital might overstate the risks, and that investors are making decisions based on subsidies rather than economics. And there was an interesting article in The Economist a few months ago where African finance ministers got together and basically said that foreign capital is overstating the risks of investing in Africa. So what we need is data that will allow governments and investors to take a portfolio approach to prioritizing infrastructure projects around the world. And what we need is to be able to compute from a government standpoint, we need to be able to compute social or economic rates of return, taking both macro and micro approaches, as well as financial rates of return, which are essentially what's going to incentivize private capital, using market-based risk-adjusted cost of capital estimates. And this is where our initiative comes in, which is the Learning from Lending initiative that was launched this summer, which is a collaboration between the Hoover Institution at Stanford, the World Bank Group, and the IDB that seeks to fill this data gap in research and policy making on infrastructure. So what is the output that we are going to be focused on? The collaboration is focused on systematically collecting, coding, and organizing in usable form from the universe of historical data on World Bank Group, IDB, both debt and equity financing of infrastructure projects in EMDEs. The idea is to produce a free, easy-to-use database on economic and financial rates of return and cost of capital for these infrastructure projects. And so many of us in this room, there's a precedence for this, which is many of us in this room have used the emerging markets database on portfolio equity. And this might surprise. The history of the EMDB database might surprise you, but it was begun in the 1980s at the IFC before financial liberalization took place across a host of emerging markets. And we see that EMDB database and having information on portfolio equity, once financial liberalization took place, has spawned an emerging market fund industry which exceeds $15 trillion today, right? So this is really, the parable of the emerging market database is really sort of one of the motivating inspirations here. So the goal is to produce and disseminate this data. We're working on collecting the financial returns using the IFC's universe of historical information on project costs, cash flows, et cetera. And then there's a sort of a complement to this, which is social and economic rates of return using the universe of historical information from the IBRD, IDA, and IDB, lending project costs, project outcomes in project countries with different sectors and projects to create this publicly accessible database that will be available to both potential clients as well as donors to compute expected and actual economic rates of return. There's already some work that's being done on this. So Peter, Pablo, and I have this macro approach that I'm going to present some of our findings today. And there are a number of work that are in process and being done at the World Bank as well. There's stuff on the Urban Spatial Network, the DIME Group. Shomik Lal and Maria Vagliasendi have applied the dual hurdle framework in the context of green investments, and Stefan Straub has conducted a meta-analysis of infrastructure. Okay, something happened here. Okay, so let me share some results that we have so far, which are based on the macro approach. So we're, what do we do here? We estimate production functions, and we're used to including labor and capital, but now we include infrastructure capital. And you can use production functions of different forms, Cobb-Douglas, translog. We can sort of make our production functions as sophisticated as we want. What does this allow us to do? It allows us to estimate the elasticities of changes in output relative to changes in infrastructure capital. Once we've recovered those elasticities, we can compute the marginal product of infrastructure capital. And along with this price data, we can compute the rates of return adjusting for depreciation, et cetera, right? So that gives us the economic rate of return. And what we, very high level, we've done this, we're doing this study based on the social rates of return on roads. What we find is that there's a very high and mean and median return. So it's basically, just think of it simply as the marginal product of infrastructure as we have computed it, adjusted for the cost of the project. However, there is a very high variance in the marginal product of infrastructure investment across countries and projects. Moreover, importantly, there's very high variation in the costs across these projects. So let me show you what we have found so far using two-lane highway cost estimates, and this is based on 50-plus countries and about 2,700 projects, and this will become clear where this 2,700 comes from. And let's think about the excess return multiples on poor country roads so far. So as I mentioned, we find a very high marginal product of infrastructure capital. The average is 106%, okay? So now we want to see, well, how does that compare to, we want to compute Rx over Rk star. Well, how does this compare to the return on foreign capital? And that average is about 7%. So if you take 106 and divide it by 7%, you get about 16 approximately. Now, we want to compare, well, is this 16 high or low? And we want to sort of compare this. And so the way that we do this is to basically think about the following thing, which is the average excess return multiple in the pre-liberalization period on emerging market portfolio equity relative to developed market equity, right? So that tells us what was this returns gap before emerging markets opened up. And that was just 1.7. Okay, so it's this 1.7 returns multiple that has spawned this emerging market fund industry. So we compared that about 16 with 1.7. We get a mean excess return multiple of 8.9. So you compare 8.9 to 1.7. I mean, that's like, it's quadruple the 1.7. The median excess return multiple is 6, and the standard deviation is 8.5. But a word of caution is warranted, which is that these aggregate estimates mask a lot of variation across countries and roads. So you can have these estimated social returns from using this macro approach can be as high as 400% in the Philippines to as low as 10% in Estonia. So the question now that we're grappling with is what drives these differences? What drives the variation? Is it differences in marginal products? Is it differences in costs? Is the variation temporal, or is it cross-sectional? So you can have a case for a project where the marginal product could be very high, but it could also be very expensive, which is going to drive down the returns. And this really highlights the need for doing this granular analysis, which allows us to distinguish between countries, identifying countries where we have these publicly efficient, privately profitable investment opportunities, and specific sectors and projects where these returns can be can be realized. So I want to advertise another World Bank data set, which is the ROCS database, which is the Road Cost Knowledge System. And this really provides a great deal of granularity of the types of road projects and roadworks that have been undertaken around the world. It can range from 2- and 6-lane highways to reconstruction, asphalt mix resurfacing, strengthening of roads. They're a lot of different projects. And the original data was in 2008, which was updated to 2018. And so what we use is this 2000 to 2017 sample period, and this gives us about 2,800 records of roadworks in 98 countries, and you can see the very high heterogeneity. The key cost that we want to focus on is the price or the cost per kilometer of building any one of these work types. And so you can see this is the summary of the ROCS database. You can see the number of projects, like we have a lot of road reconstruction and upgrading. We have the 2-lane highways. There are 87 projects in 17 countries. But what I want you to focus on is the first column, where we have the average price. Based on where price data exists, we can compute the average price of a widening and reconstruction project, or we can compute the average price to build 1 kilometer of a 2-lane highway. So what we have in the first column is the average price per kilometer, the schedule of prices, and similarly, the second kilometer has the median. We have the range and the standard error based on this information that we have computed. Now, why is this important? It's because this allows us to adopt a hedonic approach to estimate the cost of a 2-lane highway. So as you see, we only have 87 projects of 2-lane highways in 17 countries, and we might want to build 2-lane highways around the world. And so how do we think about how much that might cost us? Or we want to look at the estimates that we already have in countries based on the prices that we have and say, are these estimates reasonable? What are these price estimates telling us? So we're taking this hedonic approach, and what it allows us to do is look at this new 2-lane highway, right? So it costs about $900,000 to build 1 kilometer of a 2-lane highway. And then if we look below here, the average cost of upgrading is about $283,000. So what do these two prices give us? They allow us to compute the relative price between these two work types, right? And so we can compute the relative price. If you look at the box over there, what this allows us to do is to compute the relative price schedule for all these work types, right? You're just benchmarking off of the 2-lane highway, which is 1. Upgrading is about 30% cheaper. Widening and reconstruction is more expensive, etc. And this hedonic approach really allows us to estimate the cost of these 2-lane highways, exploiting the information that we have on all these other work types, and provides us with a sort of a much better estimate of what the price per kilometer might be. Because we're using, so even if you don't have a 2-lane highway in a country, if you have costs on say, a widening project, you can use those costs, and the assumption that we make is this relative price schedule remains constant across countries. But once you do that, you can extrapolate and populate the price schedule for all these work types in countries where we may not even have projects. And so once we have those prices, you can see that there's a great deal of cost heterogeneity, right? And so on the x-axis, we have the log mean GDP per worker. And you can see there's no relationship really between income levels and this cost variation. It's there across the board. The important thing is that the mean estimate is it costs about $1.1 million per kilometer of road, and the median estimate is about $860,000. And so you can see over here this hedonic approach. For India, for example, there was a project which was unreasonably cheap. It was just like 42,000. The data that we had was like 42,000 per kilometer of road, and you compare that to like 900,000, that just did not seem reasonable. So what does this hedonic approach allow us to do? We have hundreds of other projects in India, and then we could use that information to get a more reasonable estimate, and you see that India moves up here, like closer to the median. It's still cheaper to build a kilometer of road in India, but it's not this cheap, right? In other countries like Bolivia, we had one project of a 2-lane highway that was built in some mountain, and so that was incredibly expensive. So you would erroneously conclude that the cost of building roads in Bolivia is this high. But when we take our hedonic approach, it comes back above mean, but closer to the mean. So this is why we were using this, because these costs are incredibly important because they inform the returns, right? Because they're in the denominator in the return computation. So what this allows us to do is to compute the marginal product of infrastructure capital and returns on roads. And you can see on the left-hand side, we have the MPX calculations. And so that is the range is, the median is about 770 million, and the mean is about 1 million. And then on the right-hand side, we're plotting the returns, okay? And you can see there's some countries like up there, like Peru and the Philippines, that have very high rates of return, and then other countries that are more clustered around the mean and median. We can do this with actual costs and estimated costs. And so let's bring this back to the dual hurdle framework, and then I'll conclude, which is that now we have the return on infrastructure capital, we have the return on capital in developing countries, and we can plot this ratio, which is the domestic efficiency hurdle, using Rx over Rk. Similarly, we can plot the foreign profitability hurdle, and you can see that many of these projects exceed that threshold of 1. In fact, the median is 10.3, and the mean is 15.2. So they're way clearing the foreign profitability hurdle, and this is what that populated first quadrant would look like. And you can see all the countries based on these macro estimates that are, a lot of countries are populating this first quadrant. That is the main message here. And this provides us with the conceptual framework and the ingredients to identify these projects in countries and the excess return multiple. Let me just quickly talk about the World Bank projects that we're using to calculate using a micro approach. These are 220 World Bank projects that have been completed, but there are many work types that are road work types that are embodied in these 220 projects, and this allows us to take a micro project level approach to calculating the economic rates of return. And we can look at these implementation completion results and review reports, which are these ICRR reports, which allow us to compute both the ex ante and the ex post distribution of the economic rates of return, but these are micro estimates based on the project level data, and this is what we're pushing on in order to populate the universe, not just for roads, but for other projects. And so the macro estimates, we can think about the macro estimates as allowing us to identify countries, and the micro estimates allowing us to identify sectors and projects. This is what we have so far. We have computed this based on these 220 roads projects, but this can be expanded to the universe of public infrastructure investment across sectors, whether they be within transport, electricity, and so on. So let me conclude by saying that these preliminary estimates indicate that the potential welfare gains of capital flows from private rich capital to public poor capital can be very large. As we saw, there's a lot of variation across countries and projects, and this learning from lending initiative has the promise to increase understanding and catalyze real activity by providing these updated ingredients for the dual hurdle recipe. So what this whole data effort is engaged on is bringing better ingredients for that recipe. So let me stop there. Thank you.
Okay, great. Thank you so much. Anusha, we are going to have now some time for Q&A. Why don't you stay there? And,
Okay.
You can take the questions directly?
Yeah. Yeah.
And then I'll let you know if they have more time or not.
Yeah.
Why don't you just raise your hand, introduce yourself, and ask questions if you have any.
Thank you, Anusha, for a really nice talk and shedding a lot of light on the work that's being done on this project that we've all heard a lot about. So I wanted to go back
Introduce
Oh,
yourself.
sorry.
Mithali.
Yes, hi. I'm Mithali Das from the IMF. Nice to meet you all. Yeah, so my question was sort of right in the beginning of your presentation. You were comparing the infrastructure flows with FDI. And it seems that in many countries, FDI includes like the construction of things like roads. They can include factories. And how are you making this this assertion about infrastructure being, much lower, since FDI could be rolled into this to some extent, or not?
Yeah, that's a great question, Mithali. So what we focused that line was looking at private participation in public infrastructure projects. So that's exactly. So there could be some attenuation if some of that is rolled into FDI, but that gap is really large. So we were exclusively focusing on looking at projects that are public projects which have been able to incentivize private participation.
Hi, I'm Tim Schmidt-Eisenlohr, Federal Reserve Board. So this is, sorry, it's a little hard to talk this way. This is an amazing project. I mean, one thing that came to my mind is that I think in the US, like a long time ago under George Bush or so, pushed for this, like, let's only lend to countries that have good governments, blah, blah, blah. And so it reminded me a little bit of that, because you start with like these like extremely poor countries at the beginning, but then the argument is we should look at countries where the institutions are good enough, so the private investors are willing to invest. So I was wondering if you could look at a third dimension in your chart and think about how this looks like for countries that are different levels of development. Like if you replot this thing and you do it for the least developed countries, for emerging countries, and so on, and see how this because that's like for World Bank, for example, I guess it's a big topic that this is great, but they still care a lot about least developed countries, and if they don't fall into this quadrant, like what's the trade-off there? So I was just wondering.
Yeah, so we can actually look at this quadrant, right? Like I was, we have countries that are. What's interesting is you have countries like Nepal, which is very poor, and Nepal is all the way up there. So we can see that Senegal is here. So there are many countries in Africa. Benin is here, right? So what this approach is showing us is that if we take this rational approach to actually thinking about the rates of return, you might be surprised at how many. It's not just you have Chile, and you have Brazil, but you also have a lot of countries that might be overlooked, because that's precisely the point that the African finance ministers were making, is that sometimes suppliers of private foreign capital overstate the risks. So let's actually compute the risks and use that data to see whether investing in poor countries is really risky. Of course, now with the financial rates of return, we would need the market-adjusted cost, risk adjustments, right? So because we want to adjust for risk when we compute the cost of capital, and that's going to be the part that we want to do with the IFC. But great question. Thank you for asking.
Okay, one more question, and then, this is
All
last
right.
question.
Well, thank you. Jeannie Joseph from George Washington. I really appreciated your presentation. So when will the data be available?
Oh, so that depends on our World Bank group and IFC partners as to how quickly, and IDB partners as to how quickly we can get in there. And Yanru's here; he's our man on the ground, and we're already working on it. So it will be publicly available, and we hope not before too long.
Great, thank you very much for everyone. Thank you, Anusha. So I'm closing this great session for the next one. Thank you.
Thank you.
All right. So I'm chairing the next session. So first of all, thanks a lot again to Sergio and Thomas for this organizing this amazing this year's version of our conference. And as you know, one of the key ideas we have is like to introduce new economists in the area to like the whole crowd of us. And so William is a perfect example of that because he's a 2024 PhD. So he just joined University of Maryland, and to make it more fun, he's from Australia. He did his PhD at NYU, and the same is true for our discussant. So I'm sure he's going to be very nice to him because they share a lot. And so last thing, we have 30 minutes for the presentation and 10 minutes for the discussion. I hope that's what we told you before. And then we'll have a few minutes at the end for Q&A. And I'll try to give you some signs. We don't have that. Okay, floor is yours, William.
Okay, I see my slides here, but not sure why they're not. I don't know if that's what Sergio was running out to do. Okay. While we're waiting, actually, it's funny. Stephen also did his undergrad at the same university, ANU in Australia.
What is it? Control L?
Okay. Thanks very much, Sergio and Thomas, for organizing. So this is monetary policy and fiscal-led inflation in emerging markets. Now, the motivation for this paper is that a central goal of monetary policy is price stability. And there's a large body of evidence for advanced economies, which generally finds that tighter monetary policy, that is an increase in interest rates, reduces inflation. The impact of monetary policy in emerging markets has been relatively less studied than advanced economies. So in this paper, I want to ask the question of how does inflation respond to monetary policy in emerging markets? So the first part of the paper will be empirical, and I'm going to measure high-frequency monetary policy shocks in emerging markets. I'm going to do this using the forward and spot exchange rate, motivated by the covered interest rate parity condition. We'll see this more explicitly in a moment. And the first thing I do is validate this measure against existing monetary policy shocks in the literature and show that these give near identical results. I'm then going to use these to estimate the effects of monetary policy in emerging markets. And what I find is that for a monetary policy tightening, there's an increase in interest rates, instead of emerging markets, inflation increases, the opposite to what we generally find for the US. So that's about inflation outcomes following a monetary policy decision. I then look at market inflation expectations on a high-frequency basis and show that they also increase in line with the increase in inflation outcomes following this monetary policy tightening. So that's the empirical part of the paper. I'm then going to develop a model in order to rationalize these findings. And the key feature will be a different monetary and fiscal policy mix in emerging markets relative to advanced economies. In particular, the presence of a fiscal-led policy mix can rationalize these empirical results. And what I mean by fiscal-led is that the change in the government's budget balance to an increase in the level of government debt is relatively weak. And this, combined with accommodative monetary policy, will lead for a monetary policy tightening which increases the government's debt burden. It's a small adjustment of the government's budget balance to an increase in inflation in order to stabilize the level of government debt. So I'm going to set this out in a simple version of the model and then develop a quantitative version and estimate the parameters of that, which finds the presence of this fiscal-led policy mix for these emerging markets, rationalizing the empirical results. I then also look at the impact of US monetary policy shocks on emerging markets and show this also supports the presence of a fiscal-led policy mix. And in the last part of the paper, I'm going to study welfare and examine optimal monetary policy rules in a fiscal-led regime. So in the interest of time, I'm going to skip over the literature and discuss some key papers as we go through. So let me now give you an overview of the rest of the talk. Firstly, I'll talk about this measurement approach and the validation exercise, then the empirical results for these emerging markets, the model, and then welfare and optimal monetary policy. Okay, so the standard approach to studying the effects of monetary policy on the macroeconomy is to identify so-called monetary policy shocks. These are unanticipated changes in monetary policy. And for advanced economies, these are generally done by looking at changes in futures contracts which depend on the monetary policy rate. So for the US, looking at changes in the US Fed funds futures in a narrow window around a US Federal Reserve decision. So, however, these contracts are not available for emerging markets, which is why we need to use a different measurement approach in order to identify these monetary policy shocks. And in this paper, I'm going to use changes in the forward and spot exchange rate, exploiting the covered interest rate parity condition. So there's a recent paper by Bianchi and co-authors, which in their appendix and as a robustness exercise, they use this same measure. I'm going to apply this to emerging markets where we don't have existing measures of monetary policy shocks. Okay, so let's see one slide on the covered interest rate parity. So if we think about an investor who's choosing between saving in some currency C or in US dollars, and they face some exchange rate E, and this investor also has available to them, as for major currencies, forward contracts which allow them at time T to lock in some exchange rate F at time T plus 1. And so the covered interest rate parity condition is a no arbitrage condition for this investor, which relates the risk-free return in currency C with the return if this investor exchanged that currency into US dollars, saved at the US risk-free rate, and then converted that back at the exchange rate F. So if we take this expression, and I'm going to allow for some wedge lambda in the covered interest rate parity condition, so this measure doesn't rely on this holding exactly. There's a literature on deviations from CIP. So if we take logs of this expression, we get an equation for the interest rate differential between currency C and the US with what is referred to as the forward premium, the log difference between the forward and spot exchange rate. And what this says is that if currency C has a higher interest rate than the US, then the exchange rate must be expected to depreciate in order to equate the return on those two currencies. So if we assume around an emerging market monetary policy decision that the US interest rate is constant and any CIP wedge are constant, then we can measure a monetary policy shock by using the change in the forward premium. So I verify this assumption in the data by looking at the changes in US interest rates and government bond CIP deviations from Dew and Schrager. So this is going to be the measure which I use for a monetary policy shock for these emerging markets. So now let me talk briefly about the data and then validation exercises. So I'll be using daily data for the set of 5 emerging markets: Brazil, Chile, Colombia, Mexico, and South Africa. I choose these because they all have independent inflation targeting central banks and floating exchange rates. And I can also measure market inflation expectations on a daily basis for these economies. We're using the 1-year forward and spot exchange rate against the US dollar. When doing this for the US, I'm going to use the US exchange rate against a basket of major currencies. And I collect the monetary policy meeting dates from the national central banks. Okay, so I'll talk about these validation exercises, which I do. Just firstly, looking on a high frequency basis at the correlation between these two measurement approaches of the forward premium and existing monetary policy shocks, and then tracing out the macroeconomic effects. So I'll show you this for the US. In the paper, I also do this for Mexico and Brazil, where 2 recent papers have used other measurement approaches of futures contracts on other interest rates for these economies. And I find similar results to those. So let's see this firstly on a high frequency basis. So what I'm plotting here is on the horizontal axis, the Gertler-Karadi monetary policy shocks, where an increase is a monetary policy tightening. And so these come from the 3-month ahead Fed funds futures contracts and a 30-minute window around a US Fed decision. And each of these dots represents a US Federal Reserve meeting. On the vertical axis is the change in the forward premium on the day of a monetary policy meeting. And so you can see there's a strong positive correlation here, suggesting that on a high frequency basis, the forward premium provides a good proxy for a US monetary policy shock. So I do this for other measures of US monetary policy shocks, other advanced economies, Mexico and Brazil, as I said. So let's now look at the macroeconomic effects of these 2 different approaches. I'm going to do this following Gertler and Karadi by using a 4-variable VAR. So this is on a monthly basis, the interest rate is the 1-year government bond rate. This log of CPI is our measure of inflation. The log of industrial production is our measure of output. And the excess bond premium is a measure of corporate bond spreads over government bonds. And so the high-frequency monetary policy shock is used as an external instrument. We then trace out the impulse response to a monetary policy tightening which increases the interest rate by 1%. So you can see this monetary policy tightening leads to a decrease in inflation, decrease in output, and an increase in corporate bond spreads. And this is done using the Gertler-Karadi monetary policy shocks. If I do this using the change in the forward premium, again for a monetary policy shock which increases the interest rate by 1%, it's a fall in inflation, fall in output, and an increase in corporate bond spreads. So this suggests that studying the macroeconomic effects using these 2 different approaches provides similar results. So now let me turn to the main empirical results on the effect of monetary policy for this set of emerging markets. I'm going to do this similar to Gertler and Karadi in a panel for these 5 emerging markets from 2006 to February 2020. And I'll be using 5 variables, similar to their approach. The interest rate will be the 1-year government bond rate or the money market rate, but that's not available. The log consumer price index is our measure of inflation, industrial production, our measure of output. I'll include government debt, so this will be important when thinking about the interactions between monetary and fiscal policy. And the exchange rate. These are small open economies, so we might think that the exchange rate channel of monetary policy is important. And the change in the forward premium on a high frequency basis will be used as an external instrument for this monetary policy shock. And the results that I'll show you are robust to including time fixed effects, other variables like the local stock market, commodity prices, trade flows, US interest rates, and so on. So now let's see the results for these panel of emerging markets. Again, for a monetary policy shock, which increases the interest rate by 1% on impact, you can see in this top middle panel that there's an increase in inflation following this monetary policy tightening. So this remains positive. This increase is around 0.5% in the level of the CPI for more than 2 years following this monetary policy tightening. There's a fall in output, as we saw for the US. Little change in the level of government debt to output, and exchange rate depreciation, although that's not significant. So let me now just see that what we've seen here is for this monetary policy tightening in these emerging markets, inflation increases, the opposite to what we saw for the US, and output falls as in the US. And as I said, this is robust. We can also do things like dropping the exchange rate and government debt, including additional controls for the output gap, some external variables like exports, capital flows. So far, this has been looking at macroeconomic outcomes following a monetary policy tightening. I'm now going to look on a high-frequency basis at market inflation expectations for these economies. And so I do this by computing what is referred to as break-even inflation over the next 5 years. So this comes from the difference between the yield on a nominal government bond and inflation-indexed government bond. And this is the rate of inflation which makes an investor indifferent between these two government bonds. And I'm going to look at this on the same high-frequency basis on the days either side of an emerging market monetary policy meeting. So if I plot this for Chile, what I'm plotting on the horizontal axis is the monetary policy shock measured by the change in the forward premium, where an increase is a monetary policy tightening. On the vertical axis is the change in inflation expectations around that monetary policy meeting, and each of these dots represents a Chile monetary policy meeting. So there's a positive correlation here, suggesting that a monetary policy tightening leads to an increase in inflation expectations. And if I plot this for the other emerging markets in my sample, you can see for Colombia, Mexico, and South Africa, there's also this positive relationship. The exception is Brazil, where there's no significant relationship. So for these emerging markets as a whole, this shows that a monetary policy tightening leads to an increase in inflation expectations in line with the increase in inflation outcomes that we saw. If I plot this for the US, we find that a monetary policy tightening leads to a decrease in inflation expectations, in line with the results which we saw for the US. Okay, so that's the empirical part of the paper. Let me now turn to the model, which I use to rationalize these empirical findings. So to give you an overview, this will be a small open new Keynesian economy with home and foreign goods following Galli and Monticelli. And the novel feature will be to introduce fiscal policy from the closed economy literature, in particular building on Liepa's 1991 paper on the interactions between monetary and fiscal policy. And so we'll see that a fiscal-led policy mix can rationalize these empirical results, which we've seen. And fiscal-led policy mix is characterized by a weak adjustment of the government's budget balance to a change in the level of government debt, and accommodative monetary policy, which doesn't satisfy the Taylor principle. The rest of the world here is going to comprise a continuum of small open economies, so we'll trade goods and assets with the small open economy. And I'm going to estimate a quantitative version of this model using Bayesian methods. So let me now turn through each of the main blocks of the model, starting with the households. The representative household, who has preferences over their discounted lifetime stream of consumption, disutility from labour. Aggregate consumption is a CES of home and foreign goods, which depends on this level of openness, omega, and the elasticity of substitution between home and foreign goods, eta. The home good is itself a CES of varieties of the home good. And the households can consume, save in local currency bonds, save in foreign currency bonds, which they convert back into local currency at the exchange rate. They pay lump sum taxes, and their sources of funds are their labour income, their existing holdings of local and foreign currency bonds, and they receive the profits of the firm's lump sum. So that's the households. Let me now turn to the firms. Firms will produce varieties of the home good, and they're monopolistically competitive. They produce using labour in order to maximise their profits. We're going to assume the law of one price, standard assumption in international macro, that the price of the variety of a home good is equal to the foreign currency price multiplied by the exchange rate. I'm going to relax this in the quantitative model. Firms will set prices in a Calvo fashion. So just as in the closed economy, this gives rise to a new Keynesian Phillips curve. In the small open economy model, it's specified in terms of domestic price inflation. So domestic price inflation, if we take log deviations around the zero inflation steady state, domestic price inflation is related to the output gap and discounted expected inflation next period. Overall consumer price inflation is going to be the object of monetary policy, and that comprises a domestic component and a component coming through the exchange rate. So if the exchange rate depreciates, it's an increase in E, that feeds through to higher domestic price inflation, depending on the level of openness of the economy, omega. The last block of the model is the monetary and fiscal policy block. So monetary policy will follow a Taylor rule, adjusting the interest rate in response to the level of inflation, and the responsiveness depends on this parameter phi pi. There's some monetary policy shock M. Fiscal policy comprises a government budget constraint. The government is going to borrow in local currency bonds only. This is because for these emerging markets, during my sample period, the vast majority of their debt is denominated in local currency. They receive the lump sum revenue from the lump sum taxes on the households and have their existing holdings of government debt. I'm going to assume a standard fiscal rule for the government's policy, and this relates the government's budget balance as a share of GDP to the level of government debt as a share of GDP. This follows a series of papers by Bianchi and Melosi, which have estimated this for the US. And so this responsiveness of the government's budget balance to changes in the level of government debt depends on this parameter gamma. This captures the fiscal policy reaction. So that's the model. I then characterize the different policy regimes depending on these policy parameters. So I show that there are the following policy regimes. Firstly, a monetary-led case, where there's a strong monetary policy response to inflation and a strong fiscal policy in consolidating the government budget to an increase in the level of government debt. The second case is a fiscal-led case, where monetary policy is accommodative and there's a relatively weak adjustment of the government's budget balance to an increase in the level of government debt. And I'm going to focus on these two cases because otherwise we have no or multiple equilibria. So this extends Liepa's 1991 result to the small open economy. Now let's look at the effects of a monetary policy shock depending on these policy regimes, starting with the monetary-led. So if we have a monetary policy shock which increases the interest rate, that increases the return on savings for the households and reduces current demand. So output falls. That puts upward pressure on the level of government debt as a share of output. And because of this strong fiscal policy reaction, there's a large increase in taxes as a share of output. This further weighs on households' demand, so inflation falls. So this looks like what we saw for the US, a monetary policy tightening reduces output and reduces inflation. Now let's see for the fiscal-led case, a monetary policy shock again raises the return on savings for the household, so output initially falls and puts upward pressure on the level of government debt as a share of output. But because of this weak fiscal policy reaction, there's only a small adjustment of taxes as a share of output. So in order to stabilize the level of government debt in this economy, inflation must rise. You can see in this top middle panel. So this looks like what we saw for the emerging market estimates. So that was a simple version of the model to understand the effects. I'm going to estimate a quantitative version of the model, incorporating key features of emerging markets that we see. Firms will face a working capital constraint, incomplete exchange rate pass-through, often used in DSG models, habits in consumption, price inflation, indexation. I'm also going to allow for a rich set of shocks to demand, markup shocks, monetary policy, government spending, and to import prices, and also more general monetary and fiscal policy rules. Allow for some persistence, for example, in monetary policy to respond to both inflation and output. I'm then going to estimate the parameters of the model for these set of emerging markets using quarterly data from 2010 to 2019, using the level of GDP growth, inflation, the monetary policy rate, government budget balance, level of government debt, and the exchange rate. And these will be informative about the policy parameters. So let me now show you the main results for these set of emerging markets. So here you can see the coefficient, the estimate of the monetary policy responsiveness to inflation is, coefficient is low, it's close to zero. There's some positive response of monetary policy to output. The fiscal policy response to the level of government debt is also very low. There's some positive response of fiscal policy to an increase in output. So together, these policy parameters imply the presence of a fiscal-led policy mix for these emerging markets, rationalizing the empirical results which we saw. If I estimate this same model for the US data in the post-Volcker period, I find a strong monetary policy response to inflation and a strong fiscal policy response to levels of government debt. And this is consistent with other estimates in the literature. And it's consistent with the monetary-led regime in this case. So let me now show you the estimated results from the quantitative model against the empirics that we saw in red from earlier in the talk. And you can see for this monetary policy tightening, there's an increase in inflation in the top middle panel, as we saw in both the model and the data. Small fall in output, relatively little change in the level of government debt to output, and exchange rate depreciation. So that's the main empirical result in the paper, that inflation increases for a monetary policy tightening. And this is rationalized by the finding of this fiscal-led policy mix in this quantitative model for these emerging markets. I then also estimate the impact of a US monetary policy shock and show this also supports the presence of a fiscal-led policy mix. And I do this by pairing my results with work by my colleague Pierre de Leo, Kitty Gopinath and Sebnem, and they study for a large set of emerging markets the effect of a US monetary policy tightening. And they show that emerging markets decrease their policy rate and that output and inflation falls. So if I just summarize the results from their paper, these three moments to a US monetary policy tightening, I then look in the model at the effect of a US monetary policy shock and show that the fiscal-led policy mix can rationalize those moments, whereas the monetary-led cannot. So this is further support for this monetary-led, for the presence of a fiscal-led policy mix for these emerging markets. So in the last part of the talk, let me just mention the results on welfare of different monetary policy rules in a fiscal-led regime. And so here I'm going to look for standard business cycle shocks, markup and productivity shocks, the welfare effects of alternative monetary policy rules. So I do this is a quantitative exercise by computing welfare, which for Kolob's-Feld preferences is given by the deviation of domestic price inflation and the output gap. And so in the monetary-led case, with a standard Taylor rule, for both markup and productivity shocks, welfare increases as the central bank responds more aggressively to inflation. Now, if we look in the fiscal-led case, so the exercise here is fixing a particular fiscal policy rule and then varying the monetary policy responsiveness to inflation. And so I'm plotting welfare here for this markup shock, and you can see that welfare increases when the central bank responds less aggressively to inflation. And the same is true for a productivity shock. That there's higher welfare by decreasing this monetary policy responsiveness to inflation. So this suggests that the low estimates for this coefficient in the quantitative model may be close to optimal given the constraints of a fiscal-led regime. However, the larger recommendation from the paper is that welfare is higher in the monetary-led case. So now I'm fixing in the right-hand panel, fixing a more stronger response of the government's budget balance to a change in the level of government debt. And you can see that welfare is higher when the central bank responds sufficiently aggressively to inflation. And the same is true for a productivity shock, that welfare is higher in the monetary-led case. So this is the larger policy recommendation from this paper is a joint change in those policy rules from the fiscal-led to the monetary-led case. So let me conclude here. So in this paper, I've measured monetary policy shocks using the forward and spot exchange rate. I validated this against existing monetary policy shocks. I find that inflation increases for a monetary policy tightening in these emerging markets, the opposite to what we see for the US. And this can be rationalized through the presence of a fiscal-led policy mix in emerging markets, which I find in the estimated quantitative model. And these results are aligned with the welfare maximizing monetary policy rules in a fiscal-led regime. Thanks.
Few minutes for questions. So Anusha, I think first.
Yeah, so very interesting paper, and actually I discussed Sebnem's paper at the NBR Summer Institute last year. So very quick question is that how do the results of this of the paper how do we reconcile it with what we saw during the pandemic, which is that the narrative was really that emerging markets actually tightened before developed countries did. And, there is, now we're talking about, have they got stuck away from target? But I'm just trying to get my head around how we would think about the temporal aspect of emerging markets actually responding to inflation sooner than developed markets did. Thanks.
Let's get the second Andres. And then
thank you very much. Very, very interesting paper and also very nice discussion. No, I'd like to touch upon two things that the discussant made, which I think are important. One is the role of financial frictions and in explaining these CIP deviations, because one would think that they are more prevalent in emerging markets. But the second thing that I'd like to touch upon is the what I think is an intriguing case if you look at the results from Chile, because if there is one emerging market that I think has a quite credible fiscal rule, is Chile, right? So you would not believe that these countries in this fiscal-led regime. So I wonder if you have explored disciplining the model by showing how it can account for the behavior of fiscal variables like government expenditure. So that would give more credibility to this result. Thank you. Oh, and by the way, I think I ascribe also to Steve's suggestion that what you're finding there is really an information channel. Thank you.
Okay, all right, thanks for the comments and Stephen for the great discussion. So let me just respond to just a few points. So aware of Stephen's paper using a different measure of the 1 month interbank rate. Unfortunately, there's no overlap in our sample of countries, but I could apply that for these emerging markets. The validation of the measure which I do for Mexico and Brazil, so they use a slightly different measure, the futures contracts on the overnight interest rate. And so I again find there's a strong correlation between those. Those papers are interested in different outcomes, but I show that they, with their shocks, they also find an increase in inflation for a monetary policy tightening. So that's what I've done there. On liquidity of these markets, what I've done so far is look at the things like the bid-ask spread as a measure of liquidity in these forward contracts versus the exchange rate, and find similar results there, suggesting that it's not significant differences in the liquidity between the spot exchange rate and forward contracts. So let me talk about the post-COVID period, which I think is in people's mind of when many emerging markets tighten aggressively. So that's not in my sample. I think it's a very interesting period to look at. And so, when there's, I think, sufficient time series there, I could re-estimate this to see the effects of those on the parameter estimates. So on Pierre and Sebnem's paper with Gita, so they're estimating this for a larger set of emerging markets. Could potentially look at using their approach for this subset. On this, the trend in the level of government debt. So all I'm doing is demeaning the variables in the Bayesian estimation, which is like a standard approach. And so the time series is in there. This is exactly the time series variation which the policy rule parameter estimates are picking up, is how do these variables respond on the time series of these. So that's how that's treated, and perhaps we can talk more if there's other things I could try. On Chile, I've estimated this one by one and find one country at a time and find an increase in inflation for there. The estimates of the policy rules are for this panel. I could potentially, if I had a subset with a long time series, estimate these one by one. That's a few responses to some of those comments. I'm happy to talk more. Thanks very much.
Okay, now we have coffee break until 11:15. Let's all try our best to be back by then, because we have a lot of papers we want to see. Thanks.
You are not doing that on purpose. You only have.
All right, welcome back. So let's get started. let's get started. We have 3 great papers in front of us. So we're going to be doing 20 minutes per presentation, only clarifying urgent questions throughout, and then 5 minutes of Q&A per paper. So John, the floor is yours.
Great, thank you. It's great to see everybody. Thank you for having me on the program. And this is joint work with Carlos de Rezende at the IMF. I'm John Hodenbaugh at Johns Hopkins. And I'm going to be talking about fiscal dominance and central bank independence. It's related to what William was just telling us about earlier, so it's fortuitous. Milton Friedman, Nobel Prize winner, very famous monetary economist, wrote a whole book on the monetary history of the United States, famously claimed that inflation is always and everywhere a monetary phenomenon. And then, of course, we're economists, so we always disagree with each other. So a couple of decades later, Tom Sargent, another Nobel Prize winner, came along and said, actually, inflation is always and everywhere a fiscal phenomenon. And of course, this has been a big debate even recently in the pandemic kind of inflation experience and what we can attribute to fiscal versus monetary impacts on the supply side as well. And what I'm going to do in this paper and kind of a related set of papers that I'll try to bring in here is take both Friedman and Sargent seriously. Okay, so we're going to utilize a consolidated government budget balance that's going to incorporate both fiscal and monetary policy to try and estimate the degree of fiscal dominance across countries. And so in this particular talk, I'm going to focus primarily on the OECD economies, but we have another paper where we're doing this for emerging market and developing economies. And those results are kind of in line with what William was describing, that on average, we tend to see more fiscal dominance in emerging markets and developing economies. So what do? We're going to derive a tractable test for fiscal dominance from a micro-founded monetary model. And we have this kind of key parameter, which in some ways you can view as a deep parameter of the model. It's almost like a revealed preference of what fraction of government debt is going to be backed by the fiscal authority versus the monetary authority, okay? And so the parameter in question is kappa, so we're gonna have kappa between 0 and 1. And kappa itself is the fraction of government debt, including interest payments, that's essentially backed by the fiscal authority via present discounted value of current and future primary surpluses. And then 1 minus kappa is going to be that portion which is backed by the monetary authority through the present discounted value of seniorage. So as kappa gets closer to 1, of course, that's signaling there's less fiscal dominance. In other words, more central bank independence. That's kind of how we're characterizing it here. And we're going to provide 2 sets of estimates that I'll show you. First, sort of a very long time series static estimate of kappa. And we find for the OECD economies, kappa close to 1 or equal to 1 for countries that tend to have low average inflation over this very long time series from basically post-World War II data to 2016. And kappa tends to be lower between about 0.5 and 0.9 in economies that have higher average inflation rates. So in the OECD sample, that would include some European countries like Greece, Iceland, Italy, Portugal, and Spain. And as I said in a separate paper, we also do these static estimates for emerging market and developing economies, and there we find a lot more heterogeneity than in the OECD and lower kappas on average, so higher fiscal dominance. At the end of the talk, I'm going to show you time-varying estimates of kappa. So when we've presented this, one of the sort of obvious questions to ask is, well, what if the nature of this monetary fiscal interaction is changing over time? And so that's something we've done recently. And so I'll show you that kappas, even in the OECD, are tending to decline. So fiscal dominance is getting stronger for economies that engaged in large-scale asset purchase programs post-financial crisis. All right, so what is fiscal dominance? So some of you here might be very familiar with this. William gave us some sense of the literature as well in his presentation. There's a few ways to think about it. It's quite a broad topic. I'll try to be specific about what we're doing. One way is kind of a repeated game. So the fiscal authority sort of moves first in this repeated game, sets its fiscal variables, sequence of primary surpluses, chooses debt, and then the central bank or the monetary authority is forced to respond to that. Another way to think about that is kind of the Eric Leeper, active fiscal policy, passive monetary policy. That's kind of getting at the same outcome. But the bottom line is that fiscal dominance is going to impose constraints on the monetary authority, and if it's strong enough, if this fiscal dominance is strong enough, the central bank may be forced to accommodate deficits through money creation, which leads to high inflation. So this is a very big literature. I won't have time to mention all the papers, obviously, here, but we're very much related to kind of the Sargent and Wallace, Leeper, and Davig, Bianchi, etc. So Sargent and Wallace mentioned this unpleasant monetarist arithmetic, and the reality is that if the monetary authority is forced to accommodate the fiscal authority, debt is eventually going to be monetized and begin acting as money itself today. And so tighter monetary policy, this is very much related to what William was describing, tighter monetary policy to fight inflation today can actually exacerbate debt service costs over time, which requires or forces the monetary authority to accommodate through future looser policy. And if agents have any kind of forward-looking nature, they're going to bid up the price level as a result, okay? So just to kind of give some intuition here, in our framework, the price level, we can back out a price level that's going to be a function of, so capital M here is money supply, and capital B is debt issuance. And you can see this 1 minus kappa multiplied by debt. And so if kappa equals 1, there's no fiscal dominance, we have full central bank independence, debt is not going to have any impact on the price level. On the other hand, if kappa in the extreme case is 0, we have high fiscal dominance and debt is acting like money and bidding up the price level over time as the monetary authority is forced to monetize the debt. There's another literature, also very large, on central bank independence. The main contrast I'm going to make is that our estimates of central bank independence, fiscal dominance, are de facto, right? So we're trying to capture the actual behavioral interactions between the central bank and the fiscal authority. The de jure estimates are, of course, important, but they may be missing some of these, behavioral aspects. And so we're gonna try to get a de facto estimate of fiscal dominance. So what's the benefit of what we're doing here? It's model-based, it's tractable, this data is very publicly available, so it's easy to estimate fiscal dominance in the manner that we're doing. And again, probably the most important thing is it's a behavioral or de facto estimate of fiscal dominance. All right, so very quickly, the model we're going to use to get our testable equation has the following features. So this is identical infinitely lived consumers who have perfect foresight. That's not a crucial assumption. We can relax that, but it makes things more tractable. We're going to use money and utility, also not a crucial assumption. We can have cash in advance constraint or liquidity costs in the budget condition for the household. We'll get the same theoretical results. The key here is that, again, there's going to be a consolidated government budget balance. So the government is financing its spending through a combination of tax revenue seigniorage and new debt issuance. So the flow budget constraint for the government, we have capital G government spending, then we have the interest costs on the existing stock of debt on the left-hand side, and that has to be financed by a combination of three things. So there's tax revenues tau, there's new seigniorage, MT minus 1, and then new debt issuance, okay? And we have a no Ponzi condition to prevent an explosive path for the government debt. And if you iterate this flow budget constraint forward, you'll get an intertemporal budget constraint, as you see on the screen. So we have the interest costs on the existing stock of debt on the left-hand side equal to the present discounted value of tax receipts plus seigniorage minus government spending. Okay, and we're going to exploit that to get this testable equation that we can take to the data. So we write down a fiscal policy, the kappa backing fiscal policy, and given a sequence of prices, so interest rates and the overall price level, an initial stock of debt, the kappa backing fiscal policy is a sequence of these three fiscal variables that I just mentioned, so government spending, tax receipts, and debt, such that in every time period, the present discounted value of the primary surplus, T minus G, is going to be equal to kappa times the interest cost on the stock of debt. And then the present discounted value of seigniorage revenue, S, is going to be equal to 1 minus kappa times the interest costs on the debt. And so you can see here again the intuition, if kappa is equal to 1, then it's the fiscal authority on the left, the primary surpluses, which are going to be paying back the government's debt. If kappa equals 0, we see the opposite. So these are kind of the two polar cases to have in your mind. Kappa equal 1, we've got the fiscal authority backing government debt. The central bank doesn't have to accommodate. In the opposite case, kappa equals 0, full fiscal dominance. The central bank is exclusively backing the government debt. Okay, so that's the model, and we're going to get this nice testable equation, and I'll go through now our estimation and then show you some results. And there's not much time, so I'll do that quickly. Okay, so this data, as I said, it's publicly available. We're taking consumption, base money or reserve money, government debt. And the OECD sample includes the following countries. So just an important note here, the euro area economies were stopping the data in 1998. So obviously, when these economies join the monetary union, the ECB is setting monetary policy for the entire union. We're currently thinking about how to do this fiscal dominance estimation in the context of a monetary union where you have one central bank with many independent fiscal policies, but that's a separate paper. So our empirical estimation strategy, we're going to use dynamic OLS. We do all the necessary checks to make sure we can estimate this as a co-integrating system. All of that checks out for the results that I'm going to show you. And so this is our first set of important findings, all right? So if you look at the kappa column under estimate, so this one right here, 5 minutes, is it? So the kappa estimates, those are our static estimates of fiscal dominance or central bank independence for all of these economies, all right? So that's over the entire sample. And what you can see is many of them are close to 1 or equal to 1. So what we're finding, at least over this long time horizon, is very low or even zero fiscal dominance, which we're characterizing as high central bank independence. Now, you do see some exceptions. So I mentioned some of those at the beginning. You have Greece, Italy, Spain, Portugal, which have kappas that are less than 0.9. So signaling that there is a little bit more fiscal dominance for those economies. This is just showing you the static estimates with our confidence intervals. Another thing we can do here as kind of a robustness check is utilize this price condition that I mentioned earlier. And obviously this is a very simple price or inflation equation. We can plug in the data we have and our kappa estimates and see how close our model prediction of inflation is relative to what we find in the data. And so that's what you see on this screen. For most of these economies, given the simplicity of that inflation framework, we have fairly high correlation of our model estimates of inflation in red and the data inflation over this long time horizon in blue. Okay, I'm going to skip the structural break tests. Okay, and then the last thing that I want to focus on are these time-varying estimates of kappas. So again, when I presented this in the past, people were always asking about this, so voila. The top graph is showing you, on average across the OECD sample here, kappas, okay? So this is kind of the full sample just averaged. And what you see is, kappa kind of declines on average into the 70s through sort of the early 80s. It comes back up in the 90s and early 2000s. And then it really starts to nosedive after the financial crisis. And I'm just showing you a contrast with, on the bottom, de jure central bank independence indices, which, to my knowledge, almost all of them have been increasing, certainly on average, since the 1990s. Okay, and so I think we all have in mind different historical episodes or anecdotes where no matter how good the central bank law is that the government passes and how they choose the governor, how clean that is, it may not actually be the case that the central bank is truly independent. So that's kind of what we're showing here potentially. And just looking at a couple specific economies. So on the top, you see the United States. This is our time-varying kappa estimate. Again, the US kappas are still very close to 1. So this is not suggesting strong fiscal dominance. But you do see that it starts to decline a bit after the financial crisis. And then in the UK, it's kind of a more pronounced decline, okay? So we do this for every country in the OECD. We're expanding this now to emerging market and developing economies. Perfect. So let me conclude with 1 minute left. Fiscal dominance, in our estimates, we find lower kappas associated with higher steady state inflation. Our model estimates of inflation correlate pretty well with the data given the simplicity of this framework. In our static estimates, we're finding higher kappas, more central bank independence for economies with lower average inflation. That's not the case for economies that have higher average inflation. And then these time-varying estimates, again, we're seeing that for central banks that engaged in quantitative easing or large-scale asset purchase programs, there does seem to be a bit of a decline in kappa, signaling fiscal dominance may be expanding. And so what I showed you was paper number 1. We have a second paper, Emerging Market and Developing Economies, and we're working on the Euro area as a third project. Okay, thanks.
Thank you very much, John. You want to stay there or take questions here? Let's take a few questions. So let.
Hey, John. This is Pierre De Leo, University of Maryland. If you can intuitively explain what in the data brings you to estimate a lower degree of monetary dominance in the later sample?
Yeah, what we think is going on is the large-scale asset purchase programs, because we do see a pretty large increase in reserve money or the money supply in general. And so that may not, so for the US, for example, right, this decline is, from an economic perspective, fairly small. Obviously, qualitatively, you see it's going down, but quantitatively, cap of 0.99 versus 0.96, that's not going to have a huge effect on, say, fiscal policy beginning to influence the price level or inflation. But what we are very interested in is extending this data set from 2016 to 2023, including the pandemic period, which of course we saw many of those types of programs on overdrive and fiscal policy also on overdrive and a lot of inflation. And so I think it'll be quite helpful to kind of have that longer time series to see what's going on.
Thank you. More questions? Do you look at all in the cross-section, the jure versus de facto measure, how they connect?
So we did correlate them when we did static estimates, and we found there was some correlation. But when we started doing the time series, that's when we really noticed, again, at least for the OECD, there seems to be this disconnect. So that's something we want to dive deeper on, yeah.
Thank you. All right, thank you very much, John.
Charles, did you have a question? Yeah.
Also, I mean, following up on what we were talking about the other day, I mean, I'm not really sure money is the right concept anyway, because, you know, the reserves of the central bank are also part of the consolidated debt of the government, and, you know, large-scale asset purchases are just exchanging one kind of debt for the other. And maybe more better to think, or better, to think about fiscal dominance as William was doing it, you know, in his setup where it's not really money supply, but it's sort of fiscal rule, or what do you call it?
Yeah, I agree. I mean, as we talked about the other day, I think using, say, excess reserves rather than just base money in the post-financial crisis period when, for example, the Fed is now paying interest on reserves, right? So that might be an important distinction to make that we're not currently doing. Thanks.
All right, thank you very much, John. So let's move to the second paper. We have Ken Theo from the IMF talking about macroeconomic attention and expected returns.
Great. Thank you to the organizers for having me on this program. My name is Ken Theo, and I am with the IMF. And today, I'm presenting joint work with Eugene Larson-Hallock, who is with Capital Fund Management. The views in this paper are our own and do not reflect those of our respective organizations. What is this paper about? So we know from a very recent literature that inattention to the macroeconomy or inattention to macroeconomic shocks has been proposed as a key mechanism that can explain money non-neutrality, business cycle asymmetries. And while the mechanism is intuitive and, of course, the model implications convincing, empirically assessing the relevance of this mechanism is challenging as we do not directly observe attention allocation in the data. And so the idea of our paper is simple. It is, can we use information from the cross-section of stock returns to better understand how relevant this particular channel is, and we're interested in the firm-level attention to the macroeconomy. And this is what we do in the paper. We first propose a measure of attention to the macroeconomy through firm disclosures. We're going to find large variation in macro attention across firms, and that this attention is highly countercyclical, and this has also been established in these recent papers. What's new in our paper is we find that high attention to the macroeconomy correlates very strongly and economically significantly with lower returns. What this means is if we sort firms based on their attention to the macroeconomy into deciles and we look at their returns, we find that the returns of firms in the highest decile, the ones that pay the most attention, earn a return that is on average 13% per annum, that's lower than the expected decile. And in our sample, the market return is about 10%. So this is relatively large. And we find that this is, of course, not explained by known asset pricing factors and characteristics. And what we do is we turn to a relatively parsimonious model of macroeconomic attention and stock returns, and we find that the empirical results are consistent with the model predictions. In the model, high macroeconomic attention stocks have cash flows that load more on aggregate risk relative to idiosyncratic risk. We're going to find empirically that both aggregate and idiosyncratic risk is priced, but there is larger variation in firm-specific risks. And firms with higher macroeconomic attention have lower firm-specific risk, and that explains the negative risk premium that we observe. The data that we use are transcripts from earning calls from 2002 to 2020, Q1. And we're going to restrict our sample to US publicly listed firms, and we exclude financial stocks, given that these firms often discuss the macroeconomy for different reasons than the rest of our firms in our sample. We want to be able to identify when firms are talking about the macroeconomy, and here we rely on a training sample of Reuters news articles about the macroeconomy or company-specific news. We're going to make sure that these articles are relevant by using Google search to rank these articles every week with this very simple query that we automate. Basically, we say, look for the specific website, Reuters.com. The topic must be about the economy or a specific company name, and we're going to use a company name from the S&P 1,500. And the article must be from a given date range, and we do this every week for every week in our sample. We then implement an additional quality control measure to make sure the articles are indeed relevant. And so within the articles themselves, there are topic codes that are assigned for Google search optimization purposes. We make sure that the articles that we have are either labeled as relevant to the economy or company-specific news. And within the articles, we filter out sentences that do not have specific keywords that we find are informative about the macroeconomy or firm-specific keywords. And finally, we have firm-level returns and balance sheet data from Chris and CompuStat. Our measure to the attention to the economy is it proceeds as follows. We have a classification model that is embedding space that is used to predict the relevance of each sentence with respect to how much they actually talk about the macroeconomy. So here, M is the score, and that's going to be a function of each word, which is in an embeddings form for each sentence. And M, again, is the probability that the sentence is relevant to the macroeconomy. We then aggregate up these scores into a firm and quarter-level measure that is simply the share of sentences that are classified as macroeconomic relevant. So here, that will be the fraction of sentences with a score above a certain threshold divided by the total number of sentences in our measure. We experiment just a little bit with different types of models, and we're going to stick to relatively simple and parsimonious models. The model that I was talking about is the first one on the top, learn embeddings. So we have an embeddings model that isn't pre-trained, that is simply trained on our training data. We also have more simpler models, so we look at whether or not a certain keyword is present. That's the binary count measure, how frequent those words appear, term frequency, And we also have a pre-trained embeddings that's trained on Google News. And among these models, we find that our model of embeddings learned on these Reuters news articles achieved the highest accuracy and F1 score. So we feel a bit more confident going forward with this model. And of course, the model is trained on a different data set. So the question is, are these scores relevant to earning calls transcripts? And here's the validation exercise that we do. We basically look at the keywords within our labeled sentences in earnings calls. We filter out keywords that are common between these two labels. And here you can see that the keywords that are labeled from sentences that are labeled as macro-relevant versus non-macro relevant are relatively intuitive. And they talk about the macroeconomy in the case of macro-relevant sentences, and they talk about firm-specific issues in non-macro relevant sentences. As I mentioned earlier, one of the stylized facts that we find and is consistent with recent papers is that macroeconomy discussions of macroeconomic topics is relatively countercyclical and also relatively persistent over time. As you can see from the decline from the Great Financial Crisis. On average, firms spend about 10% of the time, 9 to 10% of their time discussing these topics. There is large cross-sectional variation in our measure, even within the firm time level. And here I'm plotting essentially the histogram of the measure. The time variation accounts for about 3% of this variation. Within time sector, that's about 38%, and between firms, that's about 50%. So about half of our variation can be explained by, it's sort of, you can think about it as within firm. We try to understand whether or not firm characteristics can explain some of this variation, and we find some very intuitive variation. For instance, if we look at a text-based measure of risk from Hassan et al. Paper, we find that firms that are riskier, tend to pay more attention to the macroeconomy. Larger firms also pay more attention. Firms that are lower book to market, so these tend to be technology stocks, tend to also be more attentive, and firms with negative earnings surprise would want to talk more about the macroeconomy. So there is some indication that all firms, maybe trying to deflect a little bit away from their own issues when they don't do so well. Of course, when we look at returns, it's going to be important for us to control for these characteristics, and we find that they do not fully explain the results that we have. Turning to expected returns, we find that higher firms that pay more attention to the macroeconomy earn lower returns than firms that pay less attention. And the difference, as you can see in the most right bar, is significant. It's about 1% per month, and that's about 13% compounded per annum. What we find is if we accumulate these returns over time, and that's shown in the blue line here, the returns are relatively sizable if we compare them to other known asset pricing factors. So you have the market return in red, and the other size, momentum, and value factors in the other colors. And you can also see that the returns tend to accrue even in non-recession periods. So this suggests that there might be information not just in the recession periods about macro attention, of the attention allocation of firms. And finally, of course, we want to make sure that these returns are not spanned by known asset pricing factors. So we report here the alpha after regressing it on these asset pricing factors, and we find that the returns here remain relatively robust. We also try to control for nonlinearities by double sorting our portfolios, first on these characteristics and factors, and then on macro attention. And again, while the coefficients are a little bit diminished, we still find them to be highly significant. And so now we turn to a conceptual framework to try to understand why is it that firms with high macroeconomic attention earn lower returns. And our framework is as follows. We think of firms as having a dividend growth process that is driven by aggregate shock and a firm-specific shock. firms are going to be heterogeneous or different in the uncertainty or the volatility of the firm's specific shock. Analysts tune in to these earning calls, and from these calls, they receive a signal of the macroeconomy, of the macro shock and the firm-specific shock that is noisy. And their goal here is to make a forecast of earnings of dividend growth that minimizes their forecast error, and they do so by choosing how much attention they pay to each of these two signals. They are subjected to a limitation in their information processing capacity, and we use a relatively standard limit that says that the amount of the reduction in uncertainty from observing these signals, these two signals, must be less than a given limit. And what we find from the model is that macroeconomic attention, or the amount of attention that the analyst pays to the macro signal, is going to be increasing in the volatility of the macro shock and decreasing in the volatility of the firm-specific shock. So in firms with high macroeconomic attention, you're going to have essentially smaller firm-specific shocks. Now we turn to try to understand returns. And here we follow the Campbell framework and decompose unexpected log returns into news about cash flows and news about discount rates. Given the dividend process that we assume, cash flow news is going to be a function of the macro shock and the firm-specific shock. And we're going to have a simple, relatively simple assumption on the process on dividend discount rate news and assume that they are similar across firms. And this is a result from the literature as well, that for a representative investor with Epstein-Zine preferences holding the market portfolio, the risk premium of any stock can be decomposed into the covariance of that stock's returns with the cash flow news of the market and the discount rate news of the market. And what we do is we say, well, we can further break that down into cash flow news driven by the aggregate shock and cash flow news driven by the firm-specific shock. In our model, the only difference across firms is going to be this correlation, this beta of cash flows that is driven by the firm-specific shock, and that's going to be decreasing for firms that pay more attention to the macroeconomy. What we then do is to try to see if this model has some bearings in the data. We estimate cash flow and discount rate news using IBIS earnings forecasts following DeLau and Mayers, 2021. We then decompose this cash flow news into aggregate and firm-specific shocks factors using a factor model. And what we are interested in is the uncertainty or the variance of cash flow news that can be explained by the aggregate factor, which is this term here, and the variance of cash flow news that can be explained by firm-specific factors, which is the residuals. Our first prediction of the model is that attention to the macroeconomy is increasing in the share of cash flow risks that is explained by macro shocks. And in this correlation, we find that to be true. So firms that pay more attention to the macroeconomy tend to have cash flows that are explained by more by the aggregate risk, factors relative to the firm-specific factors. And the second prediction is that firms with high macroeconomic attention have lower firm-specific cash flow betas. And that's, again, what we find in the data. Here, again, I plot as a function of macroeconomic attention the firm's cash flow beta with respect to the aggregate cash flow news and the cash flow beta with respect to the firm-specific cash flow news. There is, it is increasing in the aggregate, and the betas are increasing, but and decreasing in the idiosyncratic cash flow news. What we find is that there is significantly larger variation in the idiosyncratic cash flow news beta, and that would explain that would drive the negative risk premium. And so to conclude, we find that the question that we started off is, can the cross-sectional returns help us better understand this allocation mechanism? And find the answer to be positive. There is significant variation across firms, and that firms with higher macroeconomic attention have lower returns, and this is not explained by known asset pricing factors or characteristics. And we find that in a parsimonious model of attention allocation, that these empirical findings are consistent, that firms with high attention to the macroeconomy would load more on aggregate cash flow risk, less on firm-specific cash flow risk, and this larger variation in firm-specific cash flow or risk exposure explains the negative risk premium that we find. Thank you.
Thank you very much, Ken. So let's open to questions.
Okay, so can you go back to the slides where you show the cumulative return of the strategies that you have, probably page? Yeah, this page.
Yep.
So if I compare like your strategy with a market return, it seems that like all the excess return relative to the market is accumulated during the period of when the market crashed. That's 2008. And if you look at other period, like it seems that these two lines are pretty much parallel to each other. So like, how should I interpret this? Is that like, basically this is just something only work in the crisis, or like, you know, this is something else?
Yeah, that's a good point. So, so you could think of the cumulative returns as relatively parallel to the market returns during the non-crisis period, and that's the point that you're making. Well, what we've tried to do is essentially control for the market beta, and we find that this doesn't explain the excess returns. I believe we tried it at some point with the non-recessionary periods, and we find that to be true as well. And in our model, part of it is just, again, driven because the price of risk on cash flow and discount rates is different, and that would explain why the market return doesn't fully capture the excess return that we're finding. Yes.
Hi, Ken. Really interesting. And I think your channel makes a lot of sense because you're talking about how firms who talk about macro news are likely very correlated with macro news, so you can't diversify away from that risk, which sounds a lot like beta. These should be high beta. Have you tried comparing this to, again, like the betting against beta factor type thing to see if that works?
So that's a good point. I don't think we've tried that factor, so that would be a good one for us to check. We did try a number of factors and characteristics, I think about 30 plus or so, but I think we should definitely look into that. Thank you. Yes.
That's a very nice paper. I have a question. Maybe a bit misfounded, but let me try. So I think it makes a lot of sense that these low decile firms are deflecting attention but it would seem that during a boom there is a low decile and they would not want to give credit to the macroeconomy for that. They would want to. So is it symmetric?
Yes, so that is something that we don't go too much into, but that's an interesting observation. So actually, if we plot, we just plot like a bin scatter of their attention against their earnings surprise. You can use what we find is when they do well relative to what markets expect them to, they often end up just talking about their own firm-specific. So it is symmetric to some extent, although the peak is shifted towards the positive earnings surprise side. So there is some element where firms like to talk about themselves when they're doing very well, and maybe when they're not doing so well, they do attribute some of that to the macroeconomy, but they would often also end up talking about issues that would drive the negative returns. Yeah.
So let me do one more. So can you put the results of your paper a little bit in the perspective of the literature, at least in a couple of dimensions? So if you compare your empirical measure to that of Song and Stern, so are there differences there? Do you kind of rationalize the results that they do, or there are differences that you want to highlight in that regard? And second, given your findings and your framework, do you think your framework can also be use to rationalize those type of findings on returns. For example, when there is a monetary policy shock, how different firms respond.
Yeah, no, so the Song and Stern paper, I think the measure is quite close. So the difference is, I think they do a few things differently. So one is they look at, essentially, they look for keywords of macroeconomic, that is macroeconomic relevant, and they try to, they also decompose that into different topics. So that's quite unique in their measure. What we do a bit different is, and it's important for us, is we want to extract a very informative signal of this, and so that's why we rely on a more, I guess, black box to predict this attention. In terms, we have not tried looking at state dependence in monetary policy, and I think that would be interesting to see if that result is robust to using our measure. Yeah.
Thank you. All right, thank you very much, Ken. So let's go to our third paper. We have Ramona D'Agostino talking about partisan cities.
All right. Thank you so much for having our paper on the program. We're going to switch gears a little bit in the next 20 minutes and talk about partisan cities, and in particular about partisan state-city conflicts and what that means for the provision of public goods. So the decentralized provision of public goods is an essential feature in the US. And we typically think of local governments as being essential in this provision of goods, and in particular to have an advantage. And this advantage comes from being close to the constituency, and so potentially having better information, constituency being able to vote with their feet, and so that gives accountability to local governments, and obviously competition, the role of competition, people moving across local jurisdictions. However, there's a caveat, which is that local governments do not have full independence. So institutionally, local governments are thought as a creature of the state, and so they get their power, their authority from the state statute, from the Constitution. And so this means that this institutional feature restricts the ability of local governments to act independently, if you want, and so use all their wealth of knowledge, all their wealth of local information, because their ability to act is restricted by the hands of the state institutionally. And now, if you think about how complex this can become, there's another layer of complexity, which is the political layer to it. Local officials are, for the most part, not all of them, but most of them are elected mayors, and then you have the elected governor, and they belong to political parties, and we've all experienced the increase in partisan animus and political polarization over the last few years in the US. And so what we want to do is really study this idea of politics of fiscal federalism at the local level and see how these frictions, which are driven by partisan animus, these political frictions at these different layers of this, if you think of it like a cake, a multi-layer cake, of these conflicts between the partisan affiliations of the state and the local government come into play on the provision of public goods and the cost of capital for cities. So really, this is our question at the center of the paper, which is, do agency frictions driven by partisan interests between states and local governments affect the local provision of public goods? And we want to look at one particular area, which we think is very interesting, and I really don't have to motivate this in light of the recent events, which is hazard preparedness. And so think of it as emergency preparedness, and we're going to look particularly at flood risk preparedness. This is an area where local governments can invest on their own, or they can invest in a cost-sharing basis with the state. And there is no set rule. The way that this happens is on a case-by-case basis. So there is a lot of discretion by states on who needs the fund, how much we're going to allocate, what's going to happen. And so we want to study, do partisan frictions and partisan differences between the state and local government play a role here? We're going to look at the cost of financing for the local governments and at the real investment decision as their partisan alignment with the state changes over time. So when I start talking about it, typically I get two responses, and guess what? They're very polarized. I get some people that say this is obvious, and some other that say this is impossible. And typically the people who say this is impossible, they come from a very legal perspective, a legal doctrine, which is the Dion rule, which states that, as I mentioned before, cities are creature of the state. So all they do is very basic tasks, and to quote that woman from Michigan, to fix the damn road, and that's not political. So there shouldn't be any room for strategic interactions between states and local governments, because the local governments do what the state says they should do, and they do garbage collection, fix the road, non-politically polarizing topics. That's one view. And when you look at the early academic evidence, that view seems to be supported because there's a few very, very well-published papers that say that partisanship doesn't seem to play a role when we think about local government budgets, spending, and even crime rates. Well, but we think, unless you've lived under a rock in the last few years, the anecdotes paint a very different pictures. And this is all over the news, the conflicts between states and local government, and even the legal literature starts to talk about this role of preemption, of political conflicts, and how they hinder the ability of local governments to pass legislation and to decide over a whole broad range of issues: guns, environment, which is something I'm going to talk about today, bathrooms, and more traditionally budgets, the way that we allocate funds at the local level. So how are we going to tackle the question? We went on a quest to build two ginormous data sets to answer this, and we're hand-collected basically a pretty large history of partisan affiliation of local governments in the US, starting from 2005. So we know exactly which cities are governed by which mayor of which party and how that changes over time. And then we construct a detailed data set, and I really have to take my hat off to my co-author on this, on the city's adaptation on emergency preparedness and their investment in emergency preparedness at the local level. And I will talk in detail about how we build these data sets and what goes into them. I am in between your lunch, so these are the takeaways, and I want to make sure you get them early on. The partisan affiliation of cities and the partisan alignment in particular, the alignment with the state government, matters. And it matters for two things. It matters for their cost of capital. We find that when the mayor of a city shares the same political party than the state governor, then they're able to borrow cheaper and considerably cheaper. However, you'd think that since now they can borrow cheaper, they can also invest more. But we were surprised to find the opposite. That is, when you are aligned as a local government with the state governor, and so you share the same political party, you end up reducing your investment in emergency preparedness. And we think, and I'm hoping to show you some evidence that this is a moral hazard, essentially, channel, whereby you pass the hot potato of taking the risk onto the state instead of you doing the type of investment that is needed. And I'm going to talk a little bit about the mechanism and what we can do to tease them out. All right, let me talk a little bit about the data. I mentioned that we collect this partisan affiliation data set. We cover 45 states for a period 2005 to 2019, so it's pretty large. And the way that we do it is essentially we scrape the city's website. We use the Wayback Machine, and we stalk the mayors. When the mayoral affiliation is not on their website, we go on Facebook, we go on Google, we find their voting records to find the political affiliation of the mayor of that city. the state governor is Ballotpedia standard information. For their bonds, is standard data, emergence. We use the census data for the state and city budgets. And then we use the actual exposure to flood risk data from the National Flood Risk Assessment by First Street Foundation. And then we built our adaptation dictionary. And I hope you hold your breath for that, because I'll talk about that a little bit when we get to this part. So I like to show this plot, which shows how partisanship changes over time across the states. And so you see the purple states are the states that have changed their governor party over time in our sample period. In red is the usual suspects that are always Republican, and in blue, they're always Democrat states. And what I'm showing here with the dots are the cities. We focus on the cities that in our sample never changed their parties, and it'll become clear why as I show you my identification strategy. But as you can see, we have a lot of variation across states and within states in terms of the political affiliation, both of cities and of states. So we, these are, you might be familiar or not, but typically we look at municipal bonds, which are the way that local government typically finance infrastructure. They tend to be safe bonds. They tend to be, very, very highly rated. And so you see that their spreads are typically very low. But, although defaults are not massive, but they do get downgraded. And there's, as you can imagine, when we look at the city samples are very skewed. The US is made by a lot of very small towns and municipalities and a handful of large municipalities. And so that's why, when you look at the sample statistics, you see they're particularly skewed. So what are we going to do? How are we going to identify these effects? As I mentioned before, we're going to focus on cities that never changed their partisan affiliation, and we're going to look at how their alignment with their state governor and the party of the state government changes over time. How do we do that? We'll look at the changes, and so the elections, the changes in the state governors. So we look at around these electoral party switches of the state governor. And this is, we think it's possibly quasi-exogenous, because a single city will not uniquely by on its own determine what's the party of the state governor that's going to go on the power. And so what we're going to do is to compare two cities, and a city that goes from being aligned to misaligned, and one that goes from being aligned to misaligned. And so they switch their alignment because the party of the governor has changed, possibly exogenously from the single city. We're going to control for a host of bond characteristics, city characteristics. Importantly, we will control for the city fixed effects, which is going to absorb a lot of what you might think are the potential drivers of our effects. And then time fixed effects. We also will control for governor party by year fixed effects, so that we control for potentially, maybe this might be driven by the policies of a certain governor, either Republican or Democrat, but we will absorb that because we really want to just capture how the alignment changes over time and how that drives investment and cost of capital. So let's start with the cost of capital. We find that a partisan aligned city borrow considerably cheaper, between 6 and 9 basis points. So as I said, we include city fixed effects. And what does that mean? It means that our findings are not due to either Republican or Democratic cities holding different preferences over redistribution, over taxations, which might affect the way an investor perceives the riskiness of his investment, and so ultimately the price that the city pays to issue bonds. We find that the effect shows up immediately upon the election and is persistent over time. We do a bunch of falsification tests to prove that this is not spurious. And we find that the effect comes really from the pricing and not from the quantity. So we do not find an impact on the amount issue or the decision to issue. I really want to get to the mechanism. We find that this is not due to aligned cities receiving bigger transfers from the state, but we think this is coming from the probability and type of intervention of the governor into the city matters. And so this really goes into this conflict between the city and the state. How do we capture that? We use different measures to capture the governor powers. And so we look at their veto powers, we look at the power of making budget decision, elect, appoint officials. And we find that in states with higher governor powers, and so states where the governor can really step in and decide unilaterally on what needs to be done, that's where aligned and misaligned cities really differ in terms of their cost of financing, their ability, how cheap it is for them to fund themselves. We also look at the charter of the cities. So some cities are home rule, some cities are not home rule. What does that mean? Some cities have more independence, to put it simply, compared to other cities. So they do not have to ask permission from the state. And some other cities need to ask that permission from the state to change their tax rates and do other budgetary decisions. We find that the effects are concentrated in the non-home rule cities, so the cities that depend a lot from the state and need to ask permission of the state. We reinforce this idea by looking at expectations. In some states, if a city is in distress, they need to ask permission from the state to either file for Chapter 9 bankruptcy or go on into their distress policies. In other states, cities can have bigger room of maneuver to do whatever they want. And so we find that the effects are much larger in the states where the cities need to ask permission from the state. And so this really goes into the probability and type of intervention. So wherever you depend on the state, if you're aligned, you're going to benefit. If you're misaligned, too bad for you. And that translates into how investors perceive it and they price it into your bonds. I want to talk about adaptation, investment in adaptation. So up until now, you should think, well, it's easier, it's cheaper to do what you want when you're aligned with the state government, you borrow cheaper, so more projects should be positive NPV, you should do more of it. Well, we look at a host of states, and we look at their flood risk adaptation. The way that we do it is creating this dictionary by going through their budgets, their annual financial reports, and their bond prospectuses, and extract the sentences that talk about adaptation. And we create several measures to say how much they are investing, how much they are devoting of their investment to emergency preparedness adaptation. We create measures of hard adaptation, soft adaptation, general adaptation. What we find is that moral hazard prevails. And in particular, we use the same approach, which is we're not speaking about levels here. We're speaking about how it changes when you go from being aligned to misaligned, aligned to misaligned. And we see that as you go from being misaligned to aligned, your investment drops. And we interpret this as connecting to the idea that there is a probability of state intervention, which is going to be good when you're aligned and bad when you're misaligned. So we interpret this as this moral hazard channel that is, if something is going to happen and you're aligned, you know that there is this expectation of bailout, this expectation of positive intervention that a misaligned city is not having. And so it might be better off increasing its investment in emergency preparedness when it is misaligned. I only have a minute. So I want to conclude and say that we study how city-state partisan conflict affect the borrowing costs of cities, which is important because this is how cities build infrastructure, and it's a huge component of how the U.S. functions, the city-built infrastructure. And so it does not just affect their cost of capital, but also their decision and timing of investment, when they're going to invest, and in particular in this adaptation. And so we really need to think through about what it means to have fiscal federalism when there's such a polarized environment and the intervention of the state in city matters can change along party lines, because this is going to affect the public provision of public good and a very, very important public good, which is emergency preparedness, adaptation, flood risk adaptation, and I want to convince you on this. And, particularly, we want to stress that we need to think very deep about this moral hazard channel. Thank you very much, and I look forward to your comments.
Thank you very much, Ramona. Let's take a few questions.
Thank you, very interesting. I was curious if it might be worth considering also the partisan composition of the legislature, the state house. You can think of many examples. Schwarzenegger, Republican
Yes.
governor of California, but majority Dem in basically every other way. That might be a useful
it's
control.
a fantastic question. We do that. We look at the trifectas, where all the legislative chambers are all aligned, so it carries through. It's a different channel, but you see that when you have at the power a very unified party alignment, the effects are going to be stronger. So we look at that. And what we also look at, we want to see how this, we have multiple layers, and one layer that we haven't looked at is the federal government. And so maybe also the alignment with the federal government might matter, and we find that it doesn't matter. So what really matters for the city is the state. And this is not really that surprising, because really the constitution in the federal government doesn't have this direct power of a city. It's really the state that is overseeing, if you want, for lack of a better word, the municipalities. We do look at how the state fiscal strength varies, and that might vary with the alignment with the federal government. But that's a different channel. But yeah, it's a great question. We did look at it. Yes.
Super interesting. I have a question on the second half of the paper, more on the investment side. One, how often do these sort of investments need to be made? So just, can you really identify off short time periods? Or is this something you build a seawall and it's good for 10 years? I just don't know. And the second is, what about just, do they have this concept of general corporate purposes or the equivalent, where you just issue a bond and then you go to your budget, which is completely separate, so you don't need to specify in the prospectus what you're going to do with the money?
Yeah, so two fantastic questions. So on your, let me start with the second point. So when you look at bonds, typically in the standard bonds, in the data set, the typical emergent data set, what shows up is purpose of funds. And that typically is general purpose, the exact words you used. And so you're walking blind to understand what are they using these funds for. And so this is exactly why sometimes in the prospectus of the bonds, you will see that it is exactly mentioned what the bond is for, but sometimes it's just a line, sometimes it's really very vague. That's why we don't just look, we initially just looked at bonds, and then we're expanding the data set, and we're looked also at budgets, exactly as you mentioned, because that's where the mayor is gonna have to say, this is how we allocate. And we also look, and so the budgets are forward-looking. And forward-looking means that at the end of the day, they might not have done exactly what they said. And so we look also at the CAFRs, which are the annual reports, which are the accounting backward-looking. And so we see actually what did they do. And we extract this measure from all three of them exactly for that reason. So it's a fantastic point. In terms of how often, so we do this, we collect this information every year starting 2013. We started in 2013. We would like to start earlier, but again, we are scraping this data in FOIA requests, and sometimes it's just a piece of paper somewhere that we need to scan. So what we know is every year what they're doing. We do not have information of whether they did like a gargantuan investment that is, this is going to be good for the next 20 years or not. And that would be fantastic. And I agree with you. We don't have that information. And it would be very hard to tease it out, I think. But I take your point, because then it would go into the cyclicality, and that depends on the quality of that investment. So that is a wall we hit and something we can talk about. Thank you. Yes.
Thank you. It's a very interesting paper. I don't know much about this literature, but it struck me that if one has in mind an informed, strategic voter, who knows, just as you've described, that you need this alignment to get things done. Why are they not voting in the aligned party, or how do you reflect that?
So I will say two things to that. First of all, I wish people voted in the sense that more often, in the sense that when you look at turnout at the local level, it's jarringly low. And so I do not know that the typical voter is very, very aware of this channel that we're showing. And I don't even know that they are particularly aware of, how much it's costing them. I will say that sometimes in some states, the mayor needs to, for the mayor to issue the bonds, it has to be voted on and has to be approved by the citizens. So there is a degree of awareness of how much we're spending, how much we're putting on, but I don't know that there is that much awareness. And I say this academically, and also somebody who's done some work with local governments on the other side, that it's very hard to raise awareness of what's happening in the public sphere. That's the first thing I will say. The second thing I will say is that alignment changes over time, and so it's when I have another paper where we look at the political preferences of individuals, of bankers. It's very uncommon for individuals to change their political parties over time. It happens, uncommon. So for them to elect a different party, it would have to be that typically the demographics would have to change over time rather than the switch in party.
All right, so thank you very much, Ramona. Thank you very much to
so
everyone
much
for a great session. Sergio, do you want to give any lunch instruction?
Just the lunch is outside, and we'll be back at 1:30. Thank you.